Alright guys, a quick video here. I know I haven't made very many last week. I've been pretty busy. But what I wanted to go over here quickly is something that I posted during the course of the day on Friday. And as you know, Friday was non-farm payrolls. And typically that leads to some pretty good action. Uh, I would say, as far as a historical measure, that Friday's action was pretty tame compared to what we've gotten in the past. But you have to keep in mind there's a reason for that. Can you figure out what that reason is? Any reason why there really wasn't huge participation? Well, I'll give you a big clue. This coming Tuesday in the United States is the presidential election, and it is close. So there is still a lot of uncertainty in the markets. Now, I'm a moderate, okay? And this is going to be the first time ever in my life that I am not going to vote. But I don't want to get into politics. You'll have to. I'm not going to get into politics. Okay. So anyway, it was a relatively tame session, considering what usually happens during non-farm payroll. But what I want you to pay attention to on this chart is those of you who have been with me for a while know that all these lines in the sand that I have up here are known in advance. And they are points of interest. They are inflection points. They are points where institutions have deemed that to be an area that needs to either be defended or violated. And then these three lines up here, the green, the blue, and the red, are the institutional value area. And it's not your standard value area that you'll read about in profiling or anything like that. It's basically my own creation. But I want you to notice a couple of things here. I want you to notice how many times we came up to the institutional value area. Boom, boom, boom. Couldn't break it. So then we finally broke it, right? And what do I tell you about when something doesn't happen that should happen? Probability would dictate that once we broke this institutional value area, that we should have gone to the moon. Especially seeing as we tested it 3 times back here, and then we finally broke it. But we didn't. I mean, we went above it by about 7 ticks, and then just chopped around and chopped around and chopped around. That's a huge warning signal right there. Huge warning signal. Because the market did not do what it should have done based on probability. So I had alluded to the fact that if we failed up here, right above the institutional value area, like we did, that we were going to get, it was going to be bearish. And sure enough, what happened? Boom. We got hammered. So once again, you always have to keep in your back of your mind that the market should do certain things, but if it doesn't, that is a better setup than if it does do what it's supposed to do. Because it has a higher, this is kind of a strange concept to grab onto here, but if the market does not do what it should do, you actually have a higher probability of that trade working out. And there's going to be a larger move because it's shifted. Okay, so like I said, that might be a little difficult to grasp at first because in one sentence I'm saying probability dictates that this should happen. And in the next sentence I'm saying if it goes against high probability, then probability is shifted completely on its head. That's the best way I can say it. So, you know, when you see stuff like this, and you see this all the time with these institutional value areas especially, when you see these are, you should be licking your chops. And this gave you multiple opportunities to get short. You know, I mean, we were up here and we were chopping around. You know, I mean, you could have gotten short anywhere in here and not had a problem. The ideal place would have been when we came up here once, broke down, made a new low off of this consolidation right here, came back up to the exact same level again, and then could not break it. Another place you could have gotten short is right here. All right, we came down to where all those shorts are put on and broke it a little bit, came back above it, then broke it again, then came right back up to it, and right there, that should have been another area where you were saying, well, you know what, they're going to push this thing lower again, because it had absolutely nothing on it. So that's all I really wanted to touch on with this, but the institutional value areas are key. And like I said, when you get a situation where something does not happen that has a very high degree of probability that it should, that is a huge clue for you. Almost a no-brainer. I've never really put win-losses on it, but I would say it's way up there as far as probability is concerned. So just to go over exactly what I discussed here again, this value area was tested 3 times, couldn't break it. We finally broke it. We should have gone through the roof, probably should have gone up here where all these longs are put on, but we didn't. We just chopped around right above it. So that is just distribution, is what it is in a nutshell. You want to give it a definition, that is the definition of distribution. And especially on a Friday, and on a non-farm payrolls Friday, and during an election cycle, you know damn well nobody is going to want to be in the market. So there was a massive liquidation of long positions. All right. Quality over quantity. That's what I always say. So I just wanted to go over that. All right. I'm rambling. Later.